Welcome to the DJE podcast, where you will learn about real estate investing from real-life examples. Here's your host, Devin Elder.
Welcome to the podcast. I'm really excited to have Dave Childers on the podcast with us. Brief introduction here. He's managing member of Cedar Rock Capital based in Nashville, Tennessee. Got 15 years experience investing in Tennessee. And he was 25 years old when he first partnered and purchased his first rental property. And since then has gone on to do a number of larger multifamily projects and continues on the brokerage side, on the ownership side, and we'll dive into all of that. Welcome, Dave. How are you?
Hey, good. Doing great. Thanks for having
Awesome.
me, Devin.
Yeah, thanks for carving out some time, man. Appreciate it. I want to start out with a little bit of your background and how you came to multifamily real estate investing, and specifically something you told me one time that not all multifamily investors share. You've been through a cycle, right? You saw what 2008 did to the space, and you've kind of gone through that. Maybe there's some wisdom you could pass on today. But walk us through your background. How'd you come to real estate? What led you here?
Man, I moved to Nashville in 2003, kind of, doing what most people do when they move to Nashville, wanting to work in the music business, and did that for a couple years, and realized that being on a tour bus, all the time and vans, not even tour buses, was not all it was cut out to be. So, kind of had always had an interest in real estate. And I think at that time, it was all the flipping shows were going on, on every, major network. There was some kind of flipping show. So I said, man, I'm going to be a house flipper, and kind of started, telling people about it, right? I mean, that's what we tell people is, if, you got to communicate to other people. So I told a buddy, hey, I'm going to start flipping houses. And he just kind of said, hey, if you ever want to use hard money, let me know. And that relationship really took off. And, we did a few flips together. I was actually featured on TLC on the Learning Channel. I had a one episode of the Flip This House or Flip That House. I can't remember anymore. And so, that's kind of that relationship with that investor really progressed. We did a few flips, and then finally I found this 114 unit apartment. Well, let me back up. We bought a few duplexes together. So we had 6 duplexes that we had purchased. He was a California guy. I'm local here in Nashville, kind of set up, hey, you manage them, you do everything pretty much. I put the money up and we buy them as partners. That's kind of how I originally started back in my early 20s. So I found this apartment building across from a major university, Middle Tennessee State. And I said, hey, let's buy this apartment complex and do a condo conversion. And so that's what we did in 2006 or 7. So it's been 10, 11, 12, 13 years now. I've owned that apartment building. And I still own it. I didn't plan to own it. We had actually converted them to condos, and we're starting to sell them off. We were going to renovate them, and the numbers were going to be amazing. I mean, we bought these for mid-30s a door, and we're going to sell them for, 85, 90,000 a unit. With
That's
just
incredible spread.
Yeah.
I mean, what kind of lift were you guys looking at, kind of per door to
$5,000.
Oh my gosh.
Yeah. I mean, putting tile down in the bathrooms and kitchen and, new carpet and paint. We refinished the parking lots and spent some money on the swimming pool. I think I had 20 of them under contract. And that's when, 6 months in, it hit the fan. There was no financing. If anybody was watching this that was back there was like zero condo financing. So we pretty much had to go to all those people that had contracts and say, hey, we can't sell them. We're going to hold it as an apartment building. So the interesting part, college town, I had kicked tenants out. So I was about 50% occupied, and going into the fall semester, I didn't have a clue what I was doing, owning a 114 unit apartment building and having to manage it, and had, zero money. We had a bank loan on it that we thought, it was going to mature and we were going to have to pay off. So it was some hard times really, to go and now start trying to fill, 60 units in an apartment building, kind of in a bad economy. School started, so a lot of the leasing is around the school schedule. So that I tell people that was my MBA into real estate. And actually, it's something that I think my biggest concern for people getting in right now and syndicators is that they actually don't know the ins and outs of owning and managing this stuff. It's one thing to have it on a spreadsheet, but it's another thing to actually physically know what is going on day to day in a manager. So now sitting back as an owner and an owner that manages management companies and managers, I know the struggles that go on with properties, and how difficult sitting at that leasing desk or sitting at that management desk and dealing with maintenance guys or maintenance issues or leasing issues or, just tenant issues. I can feel their pain. And I think a lot of syndicators these days don't know that. And I think if there's any, problem they're going to run into is having how to figure that stuff out. So.
Yeah, that's such a good point. And there's, we can run spreadsheets and models all day long, but there's, multifamily business. It's a tough business. People are hard on the units. Got staffing issues. You've got your leasing people need to be able to close, and it's one thing to have your
and you're dealing with people's lives. I mean, I've had suicides and shootings and domestic violence and divorce, and I mean, I've seen it all. So I mean, all these people's issues become your issues. And so, I mean, it's a difficult business in that standpoint. Now, again, you're not going to read that in some marketing material from a brokerage firm or on a spreadsheet. There's no room for that. But you have to know those things are coming. So.
Yeah, that's the business. I mean, I say it a lot, you put 100, 200, 300 people together on a couple acres living on top of each other. Life's going to happen, man. I mean, and one
bad apple can ruin the property,
Right.
I mean, you have to take care of those issues immediately and get those people out. Even letting a tenant, get very, very behind on their rent and be very late, a couple months. If that ends up happening, somebody, that just sets a precedence on the property of what people think they can get away with, mostly a lower class property, a D or C property. So
people
I always
word's going to spread on that.
Yeah, doing a set out is sometimes the best thing you can do for your collections. So I told people, I said, look, just go find a bunch of junk furniture and set it out at the curb one day, and they'll say, oh man, they're taking this stuff serious. They're going to actually set our stuff out if we don't pay, so it is, I mean, that's the part that I think as I sit back right now in our market and go, what are the good things happening? What are the bad things happening? I think the operational side is I think there's syndicators that have these great big dreams, and then they're going to go head to head with a management company and say, man, we can't achieve that. We're not going to be able to take the rents up that quick or bring the expenses down or, go in there and force those people to pay. So.
Yeah, no, that's a great point. So when you had that 114 unit, two questions come to mind. Was the condo conversion something that you had a model for, or somebody was kind of helping you through that, or that was just like, hey, we can get a huge spread here if we try to sell these things?
Yeah, I mean, we had the attorney go through and give, do all the paperwork, the legal side of it, and apply for, I guess it was tax ID numbers for every parcel. And the city started kind of pushing back a little bit that we were in, and oh, sorry about that, I hit my cord, and didn't really want us to do it.
Right.
So I had to deal with the attorney in the city. I think we could have gotten past that. So no, I mean, I was a real estate agent at the time, so I knew what comps, apartments or condos that size were selling for. And so we thought, hey, parents that want their kids to own something across the street, or even a lot of investors, at that time we had a lot of investors coming from California into Nashville. So we had quite a few of those lined up that they were going to rent them out as well.
Yeah, that makes sense. So how did you tackle the management upon takeover? Were you the management company? Did you go third party?
I was living down there pretty much on this property. Hindsight, I shouldn't have been doing all those different roles. But yeah, I was somewhat managing it. I had, people I was paying hourly to help me. But I thought it was going to be a year project and I was going to walk away with $1.5 million or $2 million.
Sure.
I didn't think I would still own it this long after the fact. So
yeah, no doubt.
But I had already counted my money. Like I had picked out my Mercedes, right?
Right.
And biggest mistake, right? I look back, I'm like, man, I was such a young, dumb kid at that time. Like, how did I even ever get through that project? So
yeah. Hey, pro forma looked good, right? What could go wrong?
it did. I mean, who can mess with $6 million profit or something on something? So,
Yeah, exactly.
yeah.
Exactly. So do you, to this day, you have third party on it, or you have your own management?
Yeah. So, it took us a couple years to get it, honestly, to stabilized. We had a bank loan at that time,
Yep.
which was killing us. It's probably upside down for a few years, got it leased back up, and then started refinance a couple years ago and got it HUD financing on it. And
Nice.
one of the HUD stipulations on it was that I had to hire third-party management, which I could have taken personally, but I was super excited that I wasn't, going to have to deal with it day to day. And but it was my baby, that was a hard thing for me to give my baby that I had worked my literal blood, sweat, and tears into this property over to a management company and say, hey, take it over. And man, it is a great, then that's another skill I tell people you have to learn. You have to learn now how to manage a management company.
Right.
And so that's been something. I'd say the first 6 months I'd go by there weekly to check in on them, which they didn't need me to check in on them. Right. They were good. Now it's every 6 months I get down there 5 years later. And they do a great job, man. They get me my Monday reports. It's funny how, a good management company is keeping you so well in the loop that you're not having to chase them for information.
Absolutely.
Right?
Great point.
Monday reports, monthly financials, it's pretty clear in there, everything. You might have to ask them a few little questions, once in a while, why are vacancies high or low or whatever. So.
And have you kept that third-party management company on board since you did the HUD refinance?
Yeah. They've been on board the entire time. So, they do a great job. We could always go to, you included, go to any of our properties and probably tweak anything but
of course.
And there's the point where you're like, man, it's not worth the hassle or the argument or whatever, to try to tweak pennies, So
yeah, I mean, if you're as an entrepreneur, if you're willing to do any job in the business, you probably might be able to do it better than maybe that's doing it now. But you can't clone yourself yet, so you got to learn to work through other people. What was the HUD financing process like? I mean, I know there's some pretty attractive terms in terms of a really long amortization and crazy low rates. Was it a nightmare getting through the process, or was that relatively straightforward?
It took me 24 months to get that loan in place. And it was, I think we spent $40,000 before we closed on third-party reports.
No kidding. Yeah, just straight out of pocket. Yeah.
Yeah. I mean, it's asbestos, radon, lead-based paint. They bring a third party in that we used a company out of Virginia that did a needs assessment. So they walked every unit and said, hey, these units need cabinets. You guys need windows, and came up with all of it. They have a company come in and scope the lines. Trying to think. They know everything about that property to the point where, even tenants into the process were kind of getting tired of people coming in their apartment.
Right. Yeah, I bet.
They have to hang these radon tests in an apartment, and it has to hang in there for 24 hours, and you're not supposed to open or close doors. And then they come back. Well, doing 25% of the units at random, and then doing lead-based paint and all these different tests. And so it was, it's expensive, upfront, $40,000, on a $4.5 million loan, right? Is pretty
significant
number. Then just HUD. I'm not going to get into politics, but just working with the government, they were all over it. Had to have multiple meetings with them. Some of it might have been just because of the property and how I was managing it. I didn't have great financials. I wasn't, they would ask for, let's say 2 years of rent rolls for your property, and they all had to be dated on the same day. So if the month ended on the 28th and the next month ends up on the 30th or 31st, well, they had to all be the 28th, or they all had to be the so they would reject that stuff. You'd send it all in, and they would say, well, redo it all. So, the positives is that's a 35-year fully amortized loan, non-recourse at 4%.
Oh, fantastic. So, and that's all the blood, sweat, and tears, and that's what you end up with. And so on a net, I mean, especially now that it's a few years behind you, that process of getting a loan. I mean, those are fantastic terms to have locked in.
Well, if you're going to hold a property for a long time, because I think I just checked on the prepayment penalty on that one, and I'm at about $400,000 on a prepayment penalty because I'm only halfway through I think there's a prepayment for the first 10 years.
Right.
Now, there's other things that are bad too. I only can draw out as an owner twice a year. So that's something. Secondly, they have tons of money in reserves. That property is so liquid. But again, if you think about from a lender's perspective, it can be non-recourse because they're essentially running the property, right? So they don't need me. You can take me or my partner out of the equation, and that property will continue to do what it's doing. So, but they kind of changed the rules on us. That's the only thing I don't like is like they came in when we had that needs assessment and said, you have 5 years to replace all the windows. Well, we had our I think it's a 3-year assessment, and the lady came in and said, no, you need to go ahead and finish it all up. All the windows this 6 months, and if you don't do it in the next 6 months, then you're not going to get your owner's draw, So there's some things that I have, it's been very frustrating working with them. Replacement reserves, I think we had $500 a unit set aside. Well, they decided we needed to have $1,000 a unit. So,
wow, that's incredible. Yeah.
So another 60 grand, and make sure you fully fund that before your July draw, or you're going to miss your July draw.
Right.
So,
I mean, they need to be in a position for you to just drop dead and they are A-okay. I mean, $1,000 a door replacement reserves is.
Oh, and I mean, man, I'm at like a 40% loan to value. Well, maybe a 50 on that one now.
Wow. Yeah.
And so that's what, the last one I did a Freddie Mac SBL loan. And I mean, you get some of the same positive, non-recourse,
Sure.
6 to 10, but it was so much easier than getting the HUD loan. So.
Yeah, that Freddie SBL loan process is like, I mean, we did one last year, and I was refining a house at the same time, easier than the house, getting a $4 million loan on 100 something units, it's crazy.
Yeah. People are surprised. I tell them that all the time. I've really never worked for anybody, so I've really never had a real mortgage in my name.
Right.
And it's easier for me to walk and go to Pinnacle and get a, like you said, a $4 million SBL loan than a mortgage on a house.
Yeah. It's incredible. Speaking of Pinnacle, I was in Nashville a little while ago and saw that big Pinnacle building, and I remember looking up and go, man, I owe those guys a little over $4 million. It's crazy, but non-recourse. I was really, kind of blown away by some of the growth and everything that's happened in Nashville. I had to get a hotel really far away from downtown because I think hotels are underbuilt. But talk to us a little bit about what's going on in Nashville with the real estate market. We're recording here early 2019.
Yeah, I mean, it's still booming. We just had, I think the biggest announcement is Amazon's transportation or logistics department is moving 5,000 jobs almost to the exact corner where, we were at that event. So right downtown, 5,000 jobs. I think the average pay is $150,000.
Oh, that's huge. Yeah.
High paying jobs. So, the congestion, growth, I remember that night I tried to, instead of going home, call and get a hotel room. And the cheapest one I could find was $1,000 a night.
Yeah, that's right. It was underbuilt, right? I mean,
yeah. So I think there's 19 new hotels coming online this year here in Nashville. Wow. So, I mean, it's a boom town right now. I mean, lots of jobs, I don't know what else to say about it. It's crazy. Traffic's horrible. Not as bad as Atlanta, but, some of the things I loved about it, I guess, are gone. But, it's made a lot of us pretty wealthy if you owned anything because of the.
Yeah, sure. Somebody described it to me as a sister city to Austin. And I've definitely felt that. Obviously you got the music connection there, but great town. A lot happening there. Same thing with Austin. A lot of congestion, a lot of growth, and so on and so forth. But that's good. I want to understand a little bit about your progression. Obviously going from the smaller stuff and then getting into that 114 unit and kind of paying your dues and sticking through it. I think there's probably a lot of stories we never hear because a deal like that just crushes somebody. They wash out and that's it. They're done. I think there's probably a lot of stories like that we never hear about. But you persevered And what was next for you after that property? Obviously, you didn't just stop there. You kept investing in real estate. So how did
Yeah, but
how did that process
yeah.
prepare you?
Yeah, it definitely took the wind out of my sails, though. I really took, it made me question why to do this. I mean, I saw
Sure.
the values come down, but then there was, so a friend of mine who brokers larger multifamily came up and he said, "Hey, you need to start a brokerage firm that, you have your real estate license, you have, multifamily, you understand it now. You should start a brokerage firm, or we should start it together that focuses on selling smaller multifamily and
Right.
working with more individuals and not institutional money." And he said, "Man, I can refer you a ton of business." So, that's kind of where it progressed. I said, "Hey, I'm going to do that. I own a couple hundred units and I need a day job. So let's start this brokerage firm." And in 2011, I started a little brokerage firm called Residential Investment Advisors. And I think to date, we've sold almost 400 smaller multifamily properties. So a lot of duplexes. At that time, there was, I could have shown you a list of 150 duplexes that were all REO bank-owned properties.
Right.
And I mean, the cash flow on those properties, even in that day, were 30 and 40%. So if there's one thing I wish I would have learned about sooner was syndication, because instead of brokering a lot of those deals, I would have just found partners and partnered in on them. And so, we brokered 50, 60 a year for, a few years. And then it's kind of grown into more 10, 15, 20, 30, 40 unit complexes that we're selling now.
Yep.
But the duplexes, I mean, I helped guys become multimillionaires on those duplexes. I remember it was kind of the market was starting to kind of cool off. And I had investors going, "Man, I'm not buying that duplex. It's only a 20% return on my cash. I'm going to continue to look for the 30 and 40% return on my cash." And I would just I wanted to shake them and say, "Man, do you hear yourself? Like, you're
Yep.
complaining about a 20% return." So yeah, it's been a challenging business, just kind of evolving. The REO downtown Nashville duplexes have, obviously they've sold everyone, and there's none of those. Now the dirt's worth more than they are based on a cash flow stance, right?
Yep.
So I sold $60,000 duplexes that, might be a 8 cap at a, $200,000. Well, somebody's paying $300,000 for them to just rip them down and
Sure.
build houses. So, so that kind of, so then we start kind of going for the brokerage firm out of Nashville into different smaller, cities are still part of the metro area, and sell a lot of apartment buildings out there. So
yeah.
so that's kind of where it progressed.
Do you have a kind of a seller profile that you tend to see a lot in kind of that smaller range? 15.
Yeah. They're, professional people, doctors, attorneys, small business owners. They're looking for, just an alternative place to put their money besides the stock market.
Sure.
And so they kind of came to, I wanted to eliminate no's for people. So they would come to me and, hear all the horror stories about owning, multifamily. And I would try to say, "Hey, if you get good management and all these different, tools in your toolbox and team around you, it can be a great investment." So we've always provided tons of resources to clients that we sold properties to. And that's, I think, why we get a lot of repeat business. People that, come to us, buy, end up selling those, going, trading up in property size and buying bigger stuff. So, but yeah, professionals, people that, if you call me and the first line out of your on the phone I hear is, "I watched a commercial last night and I have no money down and I want to find owner financing," like, you're not the guy for me, right?
Right.
So I want guys that are long-term. Don't think that you're going to flip these properties in 6 months and make, money out. I want to sell to people that have that long-term strategy. And honestly, that we're not just going to help you buy one property. We're going to help you buy multiple properties. So
Yeah, I think that makes a lot of sense. And I think that's a huge value add for you guys as a brokerage to say, "Hey, look, we're owners too. And we're not just trying to step in front of a commission one time."
Right.
You're almost more like
An
acting
advisor, an investment advisor,
consultant.
Yeah.
Yeah. And I think there's a huge
Yeah.
value add. And I think that's, it's a good way to differentiate yourself from a broker that's really just kind of handling the transaction piece only. and just kind of looking out for their check. You've got a lot more to offer. So I'm sure that's a big driver for the relationships, for repeat business, everything like that. Are you guys in this market, late in the cycle? There's some news about the yield curve inverting and, kind of what's going to happen in the future. Are you guys still looking to take down your own deals? Or are you kind of waiting out,
I'll always look, but I feel like I've been sitting on my hands for the last, year and a half. Just some of these numbers, because I know, on properties I own, what people are willing to offer me on them. And I'm looking at the numbers going, I don't know how you'd make any money, right? So you know what the cash flow is on a property that you own, and think somebody's willing to pay you double what your debt service is.
Right.
And I'm I don't know how they're going to make any money on it. And so, I'm going to twiddle my thumbs. I'm not going to make any stupid moves. So I want to keep engaging with people in the business. And if a deal drop, it doesn't have to fall in my lap because I'm out there looking. But it is frustrating right now, I guess, in the market how tight it is. So
yeah, it's interesting to see some of the numbers and stuff that's selling on pro forma, and it's like stuff that's been renovated being called value add, and it's like, well, I don't know how much more value there is to add here.
It's like it's been squeezed for everything it's worth, and there's just nothing left,
Right.
And there might be a buyer that's fine with that, but that's not what I want to buy. So
sure, yeah, you got to be able to force some appreciation somehow in there.
Right.
Yeah, right. That makes sense. Are you guys looking outside of Tennessee, or you like to kind of have a
well, I mean, I do have the one property down in Pensacola, Florida. So it's that was the last one I purchased, and again, that market, it's tightened up. I was just reading an email just about renting. I mean, our rents have rent growth down there has been tremendous, but the market's definitely tightened up. That's the one I get offers for, and I'm like, man, I don't know how you'd make the numbers work. So we'll just have to wait and see. But no, I anywhere between Pensacola, Florida, and Nashville, Tennessee, Birmingham, Huntsville, dabbling in all those different markets, Chattanooga. I learned a lot, again, back to my stories of California investors investing in Nashville and then losing everything. I want to be at a place where I can, in a day's drive, be at the property. And randomly check in on it. I saw so many investors get taken advantage of that were buying things here. And, we're not talking about 100 doors. We're talking about 2 or 3 duplexes, and they had no control over the cost of maintenance and how long the unit, they just couldn't check in on it. I mean, there's something to be said about just showing up at your properties unannounced and walking vacants.
That's 100% true. I was going to ask you about the remote management. I pop in on our properties unannounced, and you get a big smile from the property. Hey, too big of a smile, right? Like, you're not that happy to see me,
right?
Popping in at 2:00 on a Tuesday. But I think there's value in that, and it keeps everybody honest. So Pensacola, the property there, obviously remote management. How has that gone for you? How's that experience been?
It's really gone well. I mean, the nice thing, somebody was asking me about sponsoring a deal the other day, and I said, well, does Southwest fly there? And they laughed. I'm like, because for Pensacola, I can buy $100 flight. I can go down in the morning, and I can be home that evening. And it's, I've gotten as cheap as $100 round trip. So it's really not that bad. So, that would be my thing. I don't want to go to, a community airport and then have to get in a car and drive for 5 hours, and make, a 3-day trip out of it. So Southwest doesn't fly there. I love the Southeast. I don't really want to go north of Nashville, maybe Louisville, Kentucky area. But it's again, I think that's another skill you start to acquire. It's how to manage a manager, now how to manage a management company from afar. And I think, as for me and my experience doing it, it might make it a little bit easier managing it from this distance. I don't know how hard it'd be as a newcomer, a newbie doing it, to be able to read between the lines and see what you need to check out. So.
Yeah, I think there's a ton of that involved, and knowing questions to ask, knowing somebody maybe is just kind of shining it up for you and just showing you the good stuff. I mean, you've got to
Right.
get a sense for the whole picture. And there's really a lot of that only comes from experience and having done it. You know, you talk about
Right.
having sat in the seat and signed the leases and hired and fired staff and, you know, gone through all that. There's kind of only one way to get some of that experience sometimes.
Yeah.
The management company that you use in remote, was that somebody that you had a relationship before? Did you go kind of interview companies in that market? How did you approach that?
The property was managed by a company, you know, from another state. They were in Atlanta, and they informed us, I don't know, 3 weeks before close that they didn't want to do it anymore. And so for me, I wanted somebody that had resources locally. You know, there's a lot of management companies that, you know, they'll manage something hours away, but not have any resources. And this particular management company, they had a portfolio of 2,000 units. They were managing about 40 minutes away. And you do that. And my properties, it was only 86 units, right? So you got one maintenance guy, one manager. But what happens when the manager's sick or the maintenance guy's sick? You know, it's hard to fill those seats. So having, you know, other properties in the general area, they can fill those rather quickly for an emergency situation. And that's why I did it. So I interviewed, I asked the broker that was brokering the deal for me, you know, can you give me a list of management companies? And, you know, you interview them and, you know, show me, you know, experience in that type of property. Because I don't want, you know, a management company that's just experiencing Class A, right? It's a Class C, some value adds, you know, some renovations, you know, what experience do you have in that? And then for me, can you run it at this, you know, per door expense rate? You know, this is my target. I think on that one, it was about a $4,000 an annual expense rate. You know, can you do it for that? Show me a budget, you know, or something. So, I think I made the right choice. They're doing a great job. So.
Yeah, that's great. That's great. And that's important to establish that relationship and get it up and running. What are some other things that, you know, some hard-won lessons over the years of managing that management company? Because if you're going to have some scale, you've either got to build a management company, and some people take that route, and that's fine, or you've got to really rely on third party to get it done effectively. Are there some other, you know, tips or some things you found to basically we're talking about the asset management layer now, right? You know, asset management kind of best practices to keep everything on track.
I mean, I have I speak to the managers one-on-one all the time. So I don't rely on an asset manager's, you know, I talk to the manager directly. They have my cell phone number because I want to know, you know, what's going on there and not have it pass through an asset management company. You know, again, accuracy in reports, you know, Monday reports. I want to see, I've asked all of them to show me renewals because I want to see how the renewals are going as much as I want to see how new lease ups are going. I think the most frustrating thing is that when I want to push rents and they pull back, I've had many times where I think that rent should increase by 15%. They talk me into 5% and lease up a unit in one day. And it's kind of I told you so. And so that, and you know, and that is just affects your cash flow for a whole year. So trying to get management companies to understand that, and most of them do. But hey, I'm the owner. This is what I want. You know, do as I direct. And if something happens, it's my fault. You know, is something I've had to try to, you know, kind of learn and be a little bit more not pushy on that subject, but forcing what I want to happen on that property. So I take their opinion, obviously, but you know, that I don't know. Sometimes I think there's a tendencies with management companies to get things leased quickly at a lower rate, and if you really don't know what the market rent is, and you just do this slow climb on it, you know, it could take you 6 months to really figure out what the market rent is. If you're only increasing by $5 or $10 a month. So.
Yeah. And then you got all these leases locked in when the true market rent's a lot higher, and you got all this loss to lease that you can't run off for a year. And, you know, that's true. A management company has different incentives than an ownership group, obviously. And if they can get you to 95% and get you off their back, they and get their, you know, delinquency and collections number down, they feel like doing a good job, which is true to an extent. But at the end of the day, especially in a syndication, we've got to drive that revenue, and
I mean, you do a calculation. Yeah, you do a calculation on a $10 or $15 rent, loss on 100 units. That's real money. It could be maybe $100,000 loss, on a 5 cap, or a 7 cap. So, I mean, having them think like that changes everything, because they're just thinking $5 or $10,
Correct.
I'm doing the math, 5 times 12, 6, doing calculations all the time. So that, and just, making sure that, how their financials, like what you mentioned, loss to lease, that was like, I didn't know that term until, 7, 8 years ago, what that actually meant. And so to watch loss to lease drop, and then see it increase, make sure you're monitoring those numbers, looking through their financials. I think too, just asking questions makes them understand that you're looking at those reports,
Right.
Why were there 3 cleaning fees on this 1 unit, or this or that? And they have to start answering those questions. They know you're looking at them then. So.
Yeah, that's a great point. As an owner, especially in a syndication where you've got other people's capital and some metrics to hit, that's the job really. The syndicator is to push on the management company and make sure that they're pushing that revenue, because the whole reason we're doing this thing really is to improve values and cash flow these deals. We were doing a due diligence today on a property, and I was talking through. Sometimes I'll invite people out to the due diligence that want to learn about this stuff and just kind of talk them through. And we were doing some quick math on covered parking, and if we could charge a little bit on X amount of covered parking divided by a 6.5 cap rate, it worked out to like $300,000 in value. And so you have this incredible metric where a little bit of net operating income increase can generate a huge either value increase that you can refinance out, or you can sell, or put on your balance sheet, whatever it is. So,
and a manager doesn't understand that. That's the big thing. And not saying they're not smart enough, they don't think that way. So I don't know if you can teach them and try to make them understand those metrics a little bit more, why it's so important to get those higher rent rates, even if it is $5 or $10. So.
Yeah, that's right. And, as the owner, you are the asset manager, or maybe you have an asset manager in house, and, or as a syndicator, you're the asset manager that's responsible for pushing on those things. And it's interesting sometimes, because a lot of times that comes down to just salesmanship. You might do X amount of renovations, and we're going to try to get this kind of, we're trying to get $100 rent increase or whatever, but somebody's got to close that deal. It's not just you're not just going to do a $4,000 renovation and boom, presto, we have a new lease here. Somebody's got to close that deal. And you talk about, the importance of the staff and the operations of the property. You've got to have somebody signing those leases.
If you don't have a manager that doesn't believe in those rent increases, or doesn't understand why market rents, and when you leave, she's dogging the property and saying, man, that I've had that happen a few times. And it's like, if you don't understand, like you said, how to sell the improvements and the rate and feel good about this property, you don't need to be sitting there in that seat for us as a manager. So, and I've had that scenario happen before. So.
Yep. It makes a lot of sense. And at the end of the day, it comes down to, like you said at the beginning, it comes down to people and operations. And, we can run all our spreadsheet numbers all we want, but at the end of the day, you got to have a good staff in there. You got to have the numbers right going in, but somebody's got to be able to execute on that thing. And on the larger multifamily property, it's not going to be you, because you can't be, in everywhere at the same time and getting all this stuff done. So you got to be able to pick the right people, or pick the right management company that has a great training and hiring program and so forth.
Yeah. So I have a funny story. I dropped in on one of my properties one day, and I knew there was a new manager. And so I went in and introduced myself, and it was the most awkward, like, I was like, I don't, so I tried to talk to her, and she goes outside and she just starts picking the property apart. Like, I don't know how you've owned this and how these people live here with this property in this condition. And, she'd come from a Class A property, and she just told me, we need to fix this curb here. And I was like, I drove off the property and I called the management company again, because, I'm not hiring the staff. They're hiring the staff.
Right.
And I said, I don't know about this girl. I just don't know if she's going to work out. I'm the owner. I've met her for 5 minutes and she's dogging my property. Right. And this is one of my babies. And, I'm like, it's a pretty nice property, and she's giving me all these things that need to be done. And so I think she lasted 2 weeks and they end up letting her go. But, that's a prime example of going to my property, talking to the manager, getting to know them. And she just, it didn't work out. So, and I think some of that stuff is, who they hire, could affect your bottom line, right?
Yep.
If it takes them a month to figure out that they're, a good fit or not. So, but you're not going to get down there and hire the people. So,
yeah, it's just not going to work if you're going to have any kind of scale whatsoever. And that's a tough transition for people, because you own a couple single family houses, you manage yourself, total control, right? You've got, but you're also sitting out there signing leases and, meeting people, and there's not any scalability in that. So you've got to figure out how to work through other people. And, that's the whole name of the game is leveraging other people's time and talent. And it's, that's the tricky part. If it was easy, everybody do it.
Yeah.
Well, that's great. If folks want to connect with you, I know we were talking offline, you guys do a meetup. You've got brokerage clients, but how should folks reach out? They want to learn more about you or what your company does.
Yeah, they can go to cedarrockcap.com or RIA-INC.com if you're in the Middle Tennessee area doing multifamily. We'd love to have you. So it's cedarrockcap.com or RIA-INC.com. My bios and contact information are on both those sites. I'd love to consult with people, coach people, syndicate, sponsor deals, anything here in the Middle Tennessee area or even Southeast. So
Excellent. Okay. Well, that's a awesome set of information, Dave. I appreciate adding some value and kind of diving in on the reality of doing this stuff, not just the highlights and the doubling our money and blah, blah, blah. This is a real life look at it. So appreciate you adding value, and folks, definitely reach out to Dave, and we'll see you next time. Thanks.
Thank you for listening to the DJE podcast. For more information, please go to djetexas.com.